Hey, everybody. Thanks for joining us again for our monthly installment of the Flex Series, the Flagstar Flex Series. John Gibson over here at Flagstar. Appreciate you taking some time to join us today. Really excited about our guest speaker today and the content. I think it's, again, extremely timely, especially with the marketplace we're in today, what's happened with rates, and really kind of a good insight into something that we should probably be looking more at and paying attention to, especially as we continue moving down the path of rest this year. It is, again, I say welcome to everybody. Hopefully everybody's doing well, healthy, safe, you and your loved ones, everybody's doing good. I know it's graduation season too, right? So you got congratulations. You got some college graduates that are out there probably moving into the real world and maybe coming off your payroll finally. High school graduations where you have people getting ready to move into that next part of their life and heading to college. So it's an exciting time of year. Summer's here and you got all those graduations. So congratulations to all the parents out there that have anybody fitting into those categories. And look, let's not forget, you got the people matriculating from fifth grade to middle school to high school. So it's an exciting time. So hopefully you're getting to enjoy that and spending time with your family as those events are happening. Hey, with that being said, like we always talk about, trying to add value. And again, I think you saw the topic for today around ARMs, getting a basic understanding of the ARM product, the nuts and bolts of it, how it works, how you should be looking at it, why should a borrower consider it, not necessarily take it, but at least be open to having the conversation with you. And we're really excited. Our partners over at MGIC, they're great. They do, they're a great partner of ours, and ended up getting on the phone with our guest speaker and Elise Mitchell, who is our account rep for Flagstar. And they had the concept of putting this on for us and putting this deck together and putting this training together. So I'm really excited for that today. And I want to introduce you to our guest speaker. So Kevin Hearden over at MGIC, he is the Director of Product Development. Give you a little bit about Kevin's background. I've got a chance to know him a little bit leading up to this, but 30-year veteran in the mortgage industry. He's had all kinds of leadership roles. So he's been in secondary marketing. He's been in capital markets, pricing and product development. And obviously at MGIC, he currently focuses on providing industry insights and developing product solutions for mortgage lenders like you as Director of Product Development at MGIC. So with that being said, I'd love to welcome Kevin onto our stage.
Thank you so much. Good afternoon. John and I were joking a little bit. We're kind of sporting the same hairstyle here a little bit. So I'm on one side of your screen, John on the other. So we're very pleased to partner with Flagstar on this, and really looking forward to sharing some basic content. So I think we're gonna go ahead and pull up the deck here, and I'm gonna take us through what we're going to cover today. So as you can see, we're titling this Getting Comfortable with ARMs. And before I get started, I do want to let you know that any opinions I share today are those of my own and not necessarily those of MGIC. So I'm going to move pretty quickly through this agenda. We've got quite a bit of detail in there. So we're going to start with why now. Why have ARMs kind of risen to the interest level that they have? You probably have a pretty good idea why that is. We'll cover some ARM basics. We'll look at a product comparison. We'll look at some borrower considerations or trade-offs, and some additional thoughts on ARMs. And then we're going to have hopefully plenty of time for Q&A. So as to the question of why now, so fixed rates on the rise, you can see here, this is the Freddie Mac Primary Mortgage Market Survey. You might be familiar with this, but it's a good kind of industry view of what's happening with interest rates. So a couple of things I'll point out here. The blue line being 30-year fixed rate mortgage. Most recent print here is 5 2/3 with 0.9 point, or 5.23 with 0.9 points. So you can see that kind of steep increase that started occurring around February. Let's go back a little bit and look, at kind of early 2021. Which we know kind of what occurred then. And you see the red line, the ARM line, and see how they're kind of on top of each other. And now they've spread a little bit and got to a fairly wide point here, at least according to the survey. a fairly wide point where there's a pretty big differential between the 30-year fixed and the ARM. So it's a combination of the amount of increase, the speed of increase, and the spread between fixed and ARMs, which is, why we're seeing, kind of the level of interest that we've seen recently.
Yeah. Hey, Kevin, real quick.
Yeah.
If you go back one slide, if you're able to go back, I
Sure
think
thing.
it's becoming more relevant now, right? Like we started hearing chatter around ARMs towards the beginning of the year as we started to see the volatility in the marketplace. But when you look at the kind of that 2 versus 10-year spread, right, you could kind of see that it was stable or not as steep of a curve, right? And now you're starting to see that shift a little bit. And as that curve steepens, you start to see this effect, what you're talking about, which is the spread between where a 30-year fixed versus an ARM prices out. It's starting to take effect where it may be more advantageous for a borrower to take an ARM in this marketplace. So it's interesting to see how that's matriculated as this year has gone on.
Absolutely. And, again, to that spread, that's what's motivating. That's what's motivating borrowers to think about other options. So let's look back a little bit, though. I want to cover a little bit of history here. So this is a chart from the Urban Institute. And what it's showing here is kind of the mix of different product. And it's showing in the blue, the ARM share. And as you see kind of the far right of our chart here, there's very little ARM share, and that we know is starting to grow. But we look back kind of pre-crisis, the 2004, 5, 6 years, when ARMs were a very large percentage of overall business. Now, I think that because within that history, people have a tendency to, in my view, kind of conflate ARM with, more directly with maybe some of the creating some of the circumstances that led to the problem with mortgages during that time. So, but you have to remember during that time it wasn't just necessarily an ARM product. What we'll be talking about today are kind of longer term ARMs that are very much kind of underwritten to traditional secondary market underwriting standards, kind of Fannie, Freddie, full qualification, full doc. What was happening during this time period of 4, 5, 6 was oftentimes there were ARMs that were very quick to adjust. They'd start adjusting after a year or even 6 months. Perhaps there were no doc or low doc options that were associated with those loans. So not kind of a full documentation of the loan. There were pay option ARMs, potentially negative amortization, interest only. So as well as even some, really higher LTVs. So it's kind of a combination of all those things, that layering of risk, I think that kind of led to, some of the performance problems we saw. And I think, although today's adjustable rate mortgages do adjust, that's the point, right? They're not typically going to contain those other features.
Yeah, it's interesting. You talk about the layers of risk, right? I do think, and I should have said this in the beginning, right? Part of the reason why I was excited about this is I do think there's a whole percentage of originators in the space that have never even sold an ARM, right? That when they've come into the industry, the only thing they've ever seen over the last however many years that they've been in it is interest rates at historically lows on a fixed component, right? In your 3s, your high 2s, your middle 3s. This is a foreign concept to some individuals. They know ARMs exist, but they've never looked at them. They've never sold them. And I think what you're talking about is the history lesson people look back on and go, well, that's the reason why this happened. That's what caused the housing crash, when in fact it was multiple layers of risk. But to your point, more importantly, today's ARM is not the ARM of yesteryear, right? It's not the no income, no asset, fog a mirror and get a loan, right? It's not a discounted teaser rate at 1%, yet you're being charged interest at this, so you have a potential neg am situation, right? Its ability to repay. It's held to all the same standards from, in essence, an ability to repay that allows the borrower to feel much more comfortable in the product. And we'll talk more about it as we move forward. But it's a great way to look back at it and say, you can't really pinpoint to one thing that caused the issue. It's multiple layers of risk. So that's kind of trying to take that myth around ARMs and saying, well, what happened in the future wouldn't happen today.
Yeah, I think that's fair. And thanks for that, John. Appreciate it. So let's start moving to some of the content here. And we're going to talk about the key structural elements of the ARMs. We'll talk about the types of ARMs. We're going to cover the index, the margin a little bit, what the fully indexed rate means, and then talk about interest rate caps. So on the basics here, the ARM types, and I refer to this is kind of my term, but product structure. So an ARM is typically going to consist of an upfront fixed period where the interest rate doesn't change, and then it's going to at some point move into the kind of the adjustable period where periodically that interest rate is going to adjust. And that upfront fixed period can range anywhere from maybe 1 to 15 years. It's a pretty big range, right? And the interest rate adjustment periods, once the adjustment starts occurring, can also, vary pretty substantially, anywhere from 6 months to 10 years. What are the most common ARMs you're likely seeing today? They're 5, 6, 7, 6, 10, 6 SOFR ARMs. I'll talk about SOFR in a minute, but for our purposes here, the 5, 6 means I'm fixed for the first 5 years, and then I'm adjusting every 6 months thereafter as the borrower in the interest rate. Whereas CMT, or constant maturity treasury ARMs, similar, fixed for the first 5 years and then adjusting annually every year after that, or fixed for the first 7 and such. So pretty straightforward. There's an initial fixed component, then adjusts periodically after that. Let's talk about the index a little bit. So the index is what determines the amount of rate change at the time the change is occurring. So between the index and margin, I'll cover margin next, but the index is kind of a reflection at the time of change of current interest rates. And that's going to kind of be like the borrowing cost, if you can think of it that way. What are some typical indices? SOFR, I mentioned, which is the secured overnight financing rate, CMT, or constant maturity treasury, often also referred to as a 1-year treasury. Those are really the core of what exists today. Used to be more LIBOR. There was a whole kind of history and some scandal around that, which precipitated the change to SOFR. So LIBOR has largely been retired, or in the process of being retired. In fact, today Fannie and Freddie will only purchase SOFR-based ARMs, but that doesn't mean other lenders might have investors might have CMT-based ARMs that you're likely to see. So let's move on to the margin. We just covered the index and now the margin. So that's also a component of the interest rate adjustment calculation. So you simply add the index or the margin to the index to help compute or calculate the new interest rate for the next time period. And it's going to vary. There's no set margin. It's going to vary based on your product. Typically, you're going to see maybe 2 to 3%, maybe even up a little bit from there. But in that range would be the margin. And again, that margin is set. Once it's defined by the product. It's set for life. It doesn't change like the index would change.
Yeah, Kevin, hey, one of the ways when I first started in the industry selling ARMs, because when I got in, fixed rates were at like 7.5%, right? It's early, like mid 90s. I got in the industry like around 94. The way I've always equated this is kind of like a formula, like you're talking about, right? You have your rate, then what makes that up? There's 2 components. One of them's fixed and the other is variable, right? So the fixed component is the margin that you just talked about. The variable component, when it can possibly change. And by the way, as you're going to see further, doesn't always change up. It can change down too, which is in the borrower's benefit. But that's the variable component, right? That's what drives the adjustability. So if you're looking at it in terms of an equation, index plus your margin equals your interest rate. And at the end of the day, the variable component is the index.
That's right on. Yeah, it is. So another kind of key component you should understand would be, interest rate caps. So those cap or limit the amount that the rate can change. And so there are three caps often associated with adjustable rate loans. So there's an initial cap. At the very first change date, how much can this interest rate change? Okay. And then there's what's called subsequent caps, or sometimes periodic cap is another term that's used. And so after that first adjustment, with each additional adjustment, how are those limited or capped? And then there's the third cap is the lifetime cap, which says over the life of the loan, how much can this interest rate change? And you notice I'm not saying increase, I'm saying change. How much can that interest rate change? And that's usually a 5 to 6%, kind of lifetime cap. Now, what are some common interest rate caps? So For SOFR-based arms, especially the shorter one, so if you think kind of Fannie and Freddie type products, the 3/6 and 5/6 arms might be a 2% initial cap, 1% subsequent, and 5. That's what the 215 stands for, and 5% lifetime. We go to another example, this last one here, for maybe a longer, intermediate to longer term arm that's based on the Treasury, maybe a 5% initial cap, 2% annual cap, and then 5% over the life of the loan. Now, what about an interest rate floor? Sometimes that floor is actually defined specifically in the product description, but oftentimes if it's not, or it'll simply state the margin. So the margin I was talking about, if we use an example of 3%, if that margin is 3%, then the interest rate will not be able to adjust below that 3% margin. That would be the floor. Let's move into fully indexed rate, because it's kind of an important concept to understand relative to ARM. So definition of a fully indexed rate is simply the index plus the margin. And this is kind of a concept that's used at origination more so than during the life of the loan at origination. And so you're simply taking whatever that current index is, whether you're using SOFR or CMT, you're adding the margin, and that's the fully indexed rate. And it's important because that's often part of the qualifying standard. The borrower may not, I'll touch on this a little bit in a few minutes, but borrower may not qualify at the note rate like they do with a fixed rate. They may qualify at a fully indexed rate or some combination thereof. So important to understand, fully indexed rate is simply at origination, index plus margin. Excuse me. So one way for us to kind of understand that a little bit better is look at an example. And so let's say today, an arm that exists and it's coming up for adjustment, just to give us a feel for kind of where this would land. So the 30-day SOFR, so the SOFR index today, right around 78 basis points, 0.78. And let's say the loan has a margin of 3, simply adding those two, we talked about that, 3.78. You round to the nearest eighth normally. That's one of the details of adjustable rate note. You typically round to the nearest eighth. So the borrower would be adjusting to 3.75. That's on a 30-day SOFR. Now, alternatively, if they have a 1-year CMT index, that's different index, different number. So we're seeing that here. That's around 2.25. So you add that 2.26 to 3, that puts you at 5.26. And then your new adjusted interest rate with rounding would be 5.25. So pretty straightforward, but important to understand that these different indices can have, pretty significant impact along with the margin as to what rate they adjust to. So to John's point, he led into this for a little bit for us is, sometimes I think that people associate ARMs with this concept, well, that means my interest rate's going to increase. And that may be true, but maybe not. We don't know. It depends on kind of the future level of interest rates. So what I've done here is just show us, remember I said SOFR is a relatively new index. And so here's kind of the history of SOFR, extremely low rates, after the onset of the pandemic, and now, starting to move up a little bit. And so we don't know what this is going to look like going forward. For a little bit of a longer term view, the CMT has been around a long time. You can see decades here of history of this graph from the Federal Reserve. We see, you're at 15%, even higher levels of that index, at certain points in its history. Obviously, we look back, to more recent history, and it's been much, much lower levels, although we're starting to increase. So just want to provide some perspective. There can be a good degree of variability, but remember, there are also the interest rate caps I talked about. So today, even if this index went up to 15%, it's likely the interest rate itself would not, because there'd be caps that would kind of limit that increase.
Yeah, and Kevin, before you move, I would tell you, right, like if you're an LO that's quote unquote getting this history lesson on ARMs today, right, the basics. This is a much longer view, to Kevin's point. However, you do have to compartmentalize it, right? Like when this index was upwards in that 15, 17%, those are times where the prime rate was at 13, mortgages, a 30-year fix was at 15, 16, 17%. You could have walked back into a bank back in those days and got a CD and gotten paid close to 8, 9% on a CD at a bank, right? So it is all relative for the time. But I think Kevin makes a great point in these two slides, which is I think the misconception about an ARM is the minute I take it, from the time I'm in it to the time it starts to adjust, it's only going to do this, which is go up. And that's not the case at all. There have been plenty of times, and look, I can tell you right now, I've had a couple mortgages in my life, and what for me personally, the best performing one was when I was in an ARM. I would still be in that loan today had I not moved, had I not sold my house, because as I look back over the 7 years I was in it and did a cost analysis, it went down for the entire 7 years I was in it compared to if I had taken a 30-year fixed. The cash flow that I saved over that 7-year period was significant. Now, that doesn't mean it wouldn't have cycled at some point and gone back up. You're going to see it in a future example. It's really what benefits the borrower based off of their situation. And Kevin's got a little bit further in the deck. He's got a great example of this.
Yeah. And I think, John, your experience wasn't unlike many others where, if it's a kind of a traditional ARM loan when the index, as you see, for example, the graph here was very low, we might be adjusting down in rate versus going up. Just a quick note on qualifying, because I mentioned it earlier. I'm not going to go through all the detail here, but you have to understand that the qualifying rate will depend on the ARM product itself, and you have to kind of watch those guidelines. For example, here, this is just from Fannie. Fannie says these shorter term ARMs, so ARMs with an initial fixed period of 3 years or less, you have to qualify at the maximum interest rate that could apply during the first 5 years. So, you have to pay attention to that. And then I'll just briefly show you, Freddie has their own kind of standards, and those can vary quite a bit. For example, on these longer term ARMs here, these 7/6 and 10/6, basically they're saying, hey, unless you have a higher price covered transaction or higher price mortgage loan, you would qualify them just at the note rate, just like you would for a 30-year fixed. So important that you kind of are attuned to and paying attention to those qualifying standards for the particular ARM products you're working with. Just a quick note on MI. Of course, you're going to be thinking of MGIC first. And so your MI premiums are going to be the same. If you have a 5-year ARM or longer, up to any term, 5 years or longer, the premium rates are going to be the same as they would be for a fixed rate. If you happen to be shorter, for an example, a 3-year ARM, there will be a little bit of an adjustment up to that premium. So just want to make you aware of that as you think about loans with MI. Okay, we just ran through quite a bit. Excuse me, I told you we're going to move pretty quickly, and we did cover quite a bit. And let's kind of pause, take a breath a little bit, and think about how does the borrower consider this, and what should they really be thinking about? So, to me, it's about trade-offs, and importantly, really kind of one trade-off, and that is the reason you would be motivated as a borrower to choose an ARM is because that interest rate, as we saw from the graph early on, would be lower than a fixed rate. If it was the same, you would not be incented, right? Typically. So let's assume there's that lower interest rate. But the trade-off for that is you don't know. You're taking the risk of an unknown rate going forward. So it's the certainty of a fixed rate versus a lower payment that could change. So to help us kind of step through that, let's look at one example here I put together, and this is for a $350,000 loan. All we're doing is looking at a 30-year fixed rate and a 5/1 ARM, and I'm just picking these rates off of that survey I showed you. That's about where a 0 point rate would be today. And so let's assume on a 30-year fixed we're at 5.5%. That would be a P&I payment of $19.87 as compared to a 5/1 ARM that we're using 4.25% here. So $17.22 a month. What's the difference in those? $265. That's pretty motivating, right? $265 in monthly savings. Now, what I did is on the next line said, well, what if I stay in this loan for 5 years for 60 months and I'm saving $265 per month? What's that going to mean? It means I'm going to save almost 16 grand over that 5-year period. So again, very substantial, a motivator. And then this next line, I want to go over a little bit carefully because I think some people miss it. So how amortization schedules and payments work is such that not only do you have an overall lower payment when your interest rate is lower, that's fairly obvious, but the amount of that monthly payment that goes to principal is going to be greater than the loan with a higher interest rate. I'll repeat that. So the amount, even though the payment's lower, the amount of that payment that's going to reduce principal is greater than the amount on a higher rate loan. So what does that mean in terms of this example? So again, if we looked at that differential over 60 months, that's additional almost $5,800. So you really have to kind of look at those two together, or you can, you choose to look at those two together. And between that, between the payment savings and that additional equity or principal reduction that you're making, it's almost $22,000.
Yeah, Kevin, I think that's interesting on the additional equity because people miss that part of the conversation, right? In another way of looking at it, just think about it as a homeowner, more of your dollar every single month is going to build equity than it on the higher interest rate, right? So more of what you pay is going to principal, less is going to interest. So you're accumulating that equity, which is a part of this conversation that people don't talk about. They would normally stop at the line right above it where they go, oh, that's the 15,900 difference over the first 5 years.
Yeah.
Without any appreciation, you're paying down the loan.
That's right. That's right. Now, to have kind of a more balanced or complete view, let's say, okay, well, that's kind of the good news. I talked about the incentive to choose a lower rate, but let's take a look at what's kind of a worst case scenario if the rate were to increase to its maximum amount. For this example, we're saying, hey, this has a 5% initial cap. And if we, at time of first adjustment, because of where the index is and with your margin, you're running up to that 5% cap. So you're moving from 4.25 all the way up to 9.25. First adjustment. So after 5 years, it just boom, all the way up to 9.25. What does that mean for your payment? Well, you went up $1,000, $1,722 all the way up to $2,722. So big jump, right? People need to kind of mentally assess that and decide, would I be, comfortable with that, or could I tolerate that if it jumped, $1,000? And then I just did a quick comparison here of the, obviously in a fixed rate, it's not going to change at any point. It's going to be 1987, your P&I. And so the differential, you went from saving $265 to spending $735 more a month in payment.
Yeah.
Now, Kevin, again,
I was going to say, Kevin, oh, go ahead.
Yeah, go ahead.
No, I was going to say real quick on this slide, if you're a loan officer talking to a borrower, as Kevin mentioned, obviously this is worst case scenario. However, if that becomes, in my mind, if I were talking to a borrower and that becomes a real concern, which it's valid, right? This could happen. I think then the conversation goes to, okay, well, what would the market actually look like for a mortgage rate to adjust to 9.25? What else would be going on? What else would you be earning on your money outside of the mortgage? What events would need to take? That's the education of the consumer, right? Because if you just show them this, there's a concern there, and there should be, rightfully so, right? But at the end of the day, the question becomes, what would be happening in the environment, in the economy, in the market for that to adjust a full 5%? Mm-hmm. And then what is that trade-off? What are you earning on other things in your portfolio, right?
Yeah, I would say back to those graphs we looked at earlier, the level of interest rates over a longer period of time. This appears to be not a likely scenario. Doesn't mean it couldn't happen, but it doesn't appear to be a likely scenario. But they just want to kind of go into it with eyes wide open.
That's right.
All right, let's kind of start to summarize this a little bit, how the borrower would think of this: ARMs versus fixed rate, advantages, disadvantages. So with the ARMs, we have a lower initial interest rate, right? That's the incentive. We talked about that. Lower payment, greater equity, at least in the short to intermediate term until that might adjust. And that's going to help borrowers save and invest. And obviously with the very dramatic home price appreciation we've seen over the last few years, that's challenged affordability substantially. And so it's a little less expensive way for them to buy a home. And the fixed rate side, nothing changes, right? So that's easy to budget, easy to understand. If income rises and payment doesn't, borrows more money for savings, it kind of easy for everyone to compute. Disadvantages, of course, covered it. Rates and payments can rise significantly. You can kind of create this risk of payment shock. Let's face it, no matter how good a job we do at origination, when it's 5 years down the road and the rate, if the rate were to adjust up substantially, there are probably going to be some cases that borrowers not kind of understanding. So that I think could be a reality. And they can be a little bit difficult for, I think, borrowers to understand and explain. And then on the disadvantage side for the fixed rates, as I mentioned, higher payment, less equity. Certainly the rise in interest rates beyond the home price appreciation I mentioned have impacted affordability for many borrowers. And then the other thing I'll just point to is, let's that's realistically every lender has a 30-year fixed rate product, right? And so to the extent you have and understand and can talk consultatively to your borrowers and referral partners about ARM options, I think that can help to differentiate you and provide that level of customer experience that you're seeking.
I think that's key, Kevin. You said that pretty quickly at the end, but what are, from a consultative approach or a value add to your real estate partners, right? Let's talk about that for a second. Inventory starting to maybe soften, right? Not saying it's happened yet, but I can speak for experience. There are 5 houses that have gone on the market on my street in my subdivision here in Northern Virginia, and they've all been on the market for almost 30 days now. If that would have been 60 days ago, these things would have been off the market the day they went on, right? You're starting to see listings kind of stabilize where you're not seeing the bidding wars above and beyond list price. So I do think as you look at and interest rates have climbed and fears of inflation, I do think as you look at affordability, ARMs become an option, right? A way to have a conversation. But to your point, it's a full service value add that you bring as a loan officer to the referral community, to your borrowers, to educate them on all of their options when looking to purchase, or obviously refinances have significantly fallen off, but to refinance as well. To understand this, it's a good way to understand it, or to explain it to your business partners, to your referral sources, to your borrowers. And it makes you a more well-rounded resource to that community, which ultimately, whether or not they take the ARM or not, leads to more business for you.
Yeah, well said. And I think it's just as you're saying, it's about providing options and helping guide the borrower to the best decision for them.
That's right.
So a little bit more on is ARM right for your customer? Some considerations. How long do they plan to be in the home? Maybe they know or have a good sense they're going to move in 3 to 5 years. So how important is payment certainty? Are they comfortable with the risk of that payment potentially increasing? What about their income? Is it relatively stable? Do they expect changes in that? Is it variable? Do they expect any upcoming major expenses that they need to kind of plan for from a holistic perspective? What are their interest rate expectations? I'd say be very careful with that. We know the Fed, right? We hear and we think, oh, the Fed's raising interest rates, and that's likely to occur, right? They've already signaled that, but that's really relatively short term. We don't know in 2, 3, 4, 5 years what interest rates are going to be like. And then again, I think you can kind of succeed by showing them the options and showing them some of the numbers. A few other considerations. So again, I'm talking in generalities here about some ARM products. You have to be really specific and understand what products your company offers. Also things to think about. There's an ARM disclosure that helps borrowers understand some of this. There's a consumer handbook on adjustable rate mortgages. And briefly on the APR, which can be a difficult concept in and of itself to understand, there's another little layer on this, and that APR on ARMs is calculated between like a blend of that initial fixed rate and then how the rate might adjust over time. So, that's something just to be aware of if the APR is like looking a little unexpected. And I'm sure your compliance officer or legal counsel or expertise in your house can kind of maybe walk you through that a little bit if it becomes more of a question. So with that, we have some time here for Q&A, and hopeful that we have some questions, and John and I will try to help you through that.
Yeah, so there's been 4 questions that I can tell that have come through. One of them is an easy answer. Jill Koss asked, could I get a copy of the slide deck? We will have that available for everybody. You'll be able to get that from your account executive from Flagstar. So that's the first one. Second one, is it possible to refinance an ARM on the first 5 years? Obviously, the answer to that's yes. Somebody takes out a product today, just like a 30-year fix or a 15 or a 20 or a 10 or an ARM, as long as the prepays don't really exist anymore, right, in this environment. So the answer would be yes. Within that first 5-year period, if they wanted to refinance, they're eligible as long as they qualify. We want to get your thought on this, Kevin. Somebody wrote to me, they actually texted me, given the past environment that we talked about arms and kind of that, I guess what I would call fear from the history of what people view arms at. Do you see, like, is there a point where affordability from a home ownership perspective will take over for the fear of potentially the misconceptions of an arm just because of the want and the need for people to get into a home?
Yeah, some thoughts on that. So if we first kind of like simplify it, and so to begin with, just an arm itself, forget about the past, is going to potentially have a little fear around it, right? And that fear is, as I talked about, it's uncertainty. So you have that, to begin with. And so and let's say your interest rate on a 30-year fixed is 5.5 today, and your interest rate on your 5-year arm is 5 3/8. So a very small difference, right? And there's a little fear associated with it. So there's probably not enough motivation to overcome that fear. Now, if you add some of this other layering in, I think it's going to depend on each borrower. Like, what are the thoughts around those? What do they understand about this past circumstances? And how big is that differential? How big is that rate incentive to get them to choose, fixed versus arm? And I think you, as a loan officer, can certainly step into that and help them understand, hey, look, that it's not really a correct view to associate today's arms with the arms pre-crisis because of the reasons we talked about, fully docked loans versus stated income, no negative amortization. All those features really are being layered on, at least for the product we're talking about today, are being layered on like they were in the past. So I think that's probably the best you can do, is educate and help them understand, and hopefully that gets them to the point where they're comfortable with whatever decision they make.
Well, and I think you're spot on, right? I think it's really a look at the moment in time when you're having the conversation. What is the marketplace? What is the borrower's motivation, right? Like, what is their necessity to get into either from a rental situation into being a homeowner, or what's driving the decision to, potentially move up, right? Like a change to the family, addition of kid, you name it, school districts, whatever the case may be. What is their true motivation in regards to home ownership? And then I think it becomes what you said, and I love the approach you've taken, which is, to me, it's always about the value add and the education, right? And the idea to think that the ARM product, the way it exists today, is the same as it was 10, 15, 20 years ago is just not true. It's really not. And to all the things you talked about, and God, we could have a whole conversation on what part did the appraisal process play in the housing crisis in regards to ordering, who was in communication with the appraisers, was there undue influence, insert all those other things. But even the appraisal industry has changed over a period of time from being regulated. So there's so many things. I mean, and I go back to it, right? The no income, no asset, teaser rate, start throwing prepayment penalties in there. There's all these different things that really contributed to it from a layer of risk perspective. So I really do think, to Kevin's point, it's much more about knowing your borrower, knowing their situation, knowing their motivation, and then making sure you educate them on the choices that they have. And then from there, they're going to decide what's best for them.
Yeah. Well, one thing I'll add to that, because you had mentioned it earlier as well, is this idea of teaser rate. Perhaps not everyone kind of has worked with ARMs enough to understand. So remember the example I was giving where we had an interest rate of 4.25 on the 5/1 ARM? Well, what we were seeing or had seen in the past, long ago past, was sometimes that start rate might be something like 1.5% or super low. And that's kind of the tease to get them in, but get the borrower into that instrument. But then what was happening is it wasn't necessarily 5 years until they adjusted. It was 6 months or a year, and they'd be adjusting up often quickly, 3.5, and that would kind of drive that payment shock scenario I mentioned.
Yeah. And, the interesting thing too is the 6-month adjustment now, I can almost make an argument, to your point, that by adjusting on a 6-month basis, it kind of evens out or takes out the peaks and valleys, so to speak, of a 1-year adjustment. You're kind of able to budget for that and adjust for it as you're coming up to the 6-month adjustment versus just waiting for a year. So it's definitely, the mechanics are a little bit different. Somebody did put in here asking a question about assumability. Yes, I can tell you the Flagstar arms are assumable. So what that does mean, for example, John Gibson, if I had a Flagstar arm on this house and I was going to sell it, fixed rates may be at 5.5, but my adjustable rate mortgage might be at 4. And again, just for illustrative purposes only, that's not real life. But it is an example where you can measure the market today, see where rates are, and that buyer of my house could in turn assume my adjustable rate mortgage and get a program or a product and a rate that's potentially much different than current market rates, depending on the situation. Now, there's a whole process they have to go through. They still have to qualify to assume the mortgage. But that is a key feature on ARMs. That's a selling point. At least I know Flagstar. Our ARMs are all assumable. There's been a couple more questions that have come through. Can you refi into another ARM? The answer is yes. You don't have to go from ARM to fix. You can go from ARM to ARM, again, as long as they qualify for the refi. And then I'll let you talk about this. Somebody wrote, talk to me more about the increased equity benefit. So that one slide where you showed savings, and it says, talk to me more about the increased equity benefit for ARMs versus fixed rate. Is this referencing the cost of waiting, or are we assuming more of the monthly payment would pay down the principal with ARMs? And I think we talked about it. I'll let you go through that again.
Yeah, it's really the latter.
That's
and
right.
I'll try to clarify this a little bit. It's not so much the fact that it is an ARM. It's the fact that the interest rate is lower. Okay. So anyone on the call could just Google and say amortization calculator. You can Google that right now, and you go in and you enter a loan amount, an interest rate, and a term, and it's going to show you an amortization schedule. Okay. And all you have to do is change that interest rate, lower that interest rate, and you'll see for yourself how much of each monthly payment is going to go to principal and how much is going to go to interest. And again, very simply, because of how amortization works, even considering the lower payment, more of that payment at a lower interest rate is going to go to reduce that principal, build that equity, and that's kind of the example we were covering.
That's right. And you'll see that in the deck when you reach out to your Flagstar AE to get it. When you look at Kevin's slide, you'll see the NAs for the fixed rate because that's fixed. It's not changing. And you're comparing, in this case, the ARM product at a lower rate compared to that principal and interest payment. But Kevin's right. It's not necessarily because it's an ARM. It's because you're making, it's a lower interest rate. So more of your money is going to principal and less is going to interest.
That's right.
Yep. Where was the other one? Tony commented, I don't necessarily think this is for you. I think this is for me at Flagstar. He wanted to know, when do you plan to roll out a competitive ARM product? So I'll tell you two things, Tony. One, and I was going to mention this before we got off. When Kevin and I were talking earlier about the 2 versus 10-year spread, right? Right now, if you look at it from a treasury perspective, if you were, in essence, I don't want to pull a chart up, but if you were looking at the 210 yield curve right now against each other, it's not really that wide of a delta that it would say a borrower would want to choose an ARM over a fixed on a conforming type of situation. 2, the pricing that we see from the bond market and literally the appetite for that, it's not there yet, right? It hasn't come around to what we may have seen in previous times where the spread between fixed and ARMs were so significant. I absolutely think we're moving in that direction. So it's not that we don't have a competitive ARM. It's that the market hasn't moved to a point that it's that advantageous for bond buyers, i.e. where we see pricing coming from, that allows us to actually have that big of a delta, but it's growing, right? You saw Kevin's chart earlier with the Freddie Mac, I think it was the 30-day average, 30-day rate. You can see that gap's widening. So as that continues to happen and that 210 curve steepens, you'll see ARM pricing getting much more attractive compared to a 30-year fixed. The other thing I will tell you is where the ARM market has come into play is on the jumbo side of the house. So if you're looking at jumbo, right, higher loan amounts, think 700, 750, we've seen $1 million and higher. that is where it's come back quickly, because to Kevin's chart, if you're looking at a jumbo fixed arm, a jumbo fixed versus a jumbo arm, the delta is significant there. And the cost savings ramps up higher because your average size loan amount is higher than a conforming loan amount. I will tell you there, if you haven't looked at Flagstar for that outlet, you should. We're doing 20 to 30 million a day in that product right now on a jumbo arm. And that is where the market has come back significantly. I don't know if you have any thoughts on that, Kevin, versus the
I do, just to kind of underscore your point on the jumbo piece. So within the last few weeks, the high point of the ARM penetration, according to the MBA weekly application survey, was 11% of units, 19% of dollars. So what does that mean? Higher dollar amounts associated with ARMs. So I think that just is right in line with the comment you made about jumbo ARMs being a big part of the conversation.
And then another one that came through, and I'll just read it to you and want to get your opinion on this. And obviously, it's a crystal ball type of situation, right? Who knows, but we can give at least some thought around it. It was, given the scarred borrower community from the financial crisis. So again, referencing back to what we've been talking about, how big do we think the ARM market could get going forward, maybe as an overall percentage? I know you had a couple charts on there that showed kind of the penetration or the market share of an ARM. What are your thoughts around that?
I think my view is I tend to take these to the transactional level. And I was kind of speaking about this before a little bit. If I'm a borrower and I'm coming to you as a loan officer and you are presenting to me the options, what's the extent of my motivation? Are we showing a borrower an ARM rate that's substantially lower than a fixed? And that is really, in my mind, the driver of how much ARMs will become a portion of the market. And the other piece to this, and maybe I'm being a little repetitive, but to the extent you are educating them about what this ARM really means and how it might be different, is many of these folks won't kind of have that mental residue of what happened in the past. So it's not necessarily ground you need to cover or stir up. But for those that do, for you to explain succinctly that those layering of risk, other risk components are not involved. Here's what your offering looks like. Here's what your option is. Let's talk about whether that's the right fit for you.
Well, and Kevin, I think you're spot on. And I think when you see this deck that you can get from us, and thank you again to MGIC for doing this for us, I think it's all of that, right? It's the understanding of why what was in the past isn't today's ARM. I think it's understanding the motivation of the borrower. I think it's being able to talk to, like Kevin did on that slide, and showing kind of the options, right? Hey, here's your 30-year fixed option, right? And here's what that gives you. And here's the Ben Franklin plus and minuses of a 30-year fixed. But here's an ARM, and here's what it looks like, and here's how it works, and here's what that looks like. And then you show the savings and what those payments look like. And then you start asking the questions that I thought Kevin did a really good job putting together for us on that one slide about things to consider as a borrower. How long are you going to be in the house, right? I don't know. There's a 5, a 7, and a 10. So 5, 6, 7, 6, 10, 6. At the end of the day, what is their motivation? And does it make more sense because they know, like, maybe they're moving into this area for the school district for the high school that they want their daughter or son or kids to go to. Well, they're going to be freshmen and sophomores. Okay, that's a 4 or 5 year window. When those kids go to school, do they plan on downsizing? So, okay, you might not only be here for 5 years, but hey, what if take 7, you got the extra 2, and if you sell in 5, great. But I think the one thing I would tell you as an LO is know your own obstacles, right? Walking into a conversation with a borrower that potentially it's the past that they're going to be concerned about. There's always going to be the fact that it adjusts. You need to be able to address that head on. To Kevin's point, I don't know if I would create an objection if there's not one, but if somebody wants to have the conversation about, well, why can't this perform like it did in the past? Then you have all the ammunition or the information, so to speak, to have an intelligent conversation with somebody. Trying to go back through the questions real quick to see if we missed any, Kevin, but they were coming in fast and furious as we got to Q&A. Deck, and then somebody asked, where was it? Thank you so much. Are there any future ARM workshops that will be geared more towards compliance guidelines for ARM products? I mean, I think that was Orlando put that out there. One, I would tell you MGIC, and I know Kevin, I think we had put this down below. You can follow Kevin at mgic.com and you can get a lot of information from them. We can certainly take that into consideration, Kevin, and put something together as well as a follow-up. And then obviously our AEs are well-versed in, guidelines from a regulatory perspective, testing, compliance testing on loans. Because look, there's other testings that go on these things too, right? QM, points and fees, your APOR plus your 2 1/4 test. So there is some of that stuff that you need to know as well. And between MGIC and Flagstar, we can certainly either A, put on another session, and or B, get you the information that you're looking for. So good call out there. Kevin, I think that's it, buddy. From what I can see, I think we've addressed everything. Any closing thoughts on from your perspective?
Yeah, nothing more on ARMs. We covered quite a bit today, so hopefully, the folks got some good information and worthwhile investment of their time. So just thank you, Flagstar. Appreciate this. It's fun, John. We haven't done this before. I'm glad we had an opportunity to get together.
I appreciate it, Kevin. Thank you so much. And I know Elise wasn't able to join us, but I'm going to give a shout out to Elise. She's great. She's awesome. She's the one that kind of came to us and said, hey, we have this thing we're thinking about putting on. Do you want to be part of it? And we're like, do you want to be part of our Flex series? Because this lines up really well. So, Kevin, thanks for taking the time. I appreciate it. And thanks for all the information for everybody. Certainly, hopefully it was value for everybody.
Yeah, our pleasure.
Awesome. All right, gang. Hey, well, I know we ran over a little bit, a lot of questions, important topic, especially as the market's shifting. Look, obviously, volume in the overall market's being impacted by a lot of different things that we talked about today. So having, every card in the deck, so to speak, at your disposal when you're talking to your referral sources and talking to potential borrowers or repeat borrowers certainly, gives you a leg up versus your competition. And I do believe gives you a greater percentage of being successful in your efforts. So look, intro of the ARMs. If you haven't heard about them, talked about them, sold them. If you have, it's a refresher. Tried to give you basics, tried to give you components, tried to give you some scenarios, and certainly tried to give you ways to look at it. And more importantly, ways to think about it when you're talking to the homeowner or your potential borrower, right? So certainly appreciate it. And then I think we have a slide for our next one to tease, but obviously we do these every month. Second Thursday, 2:00. The next one, we're going to have John Tallinger, Chief Growth Officer, and John Frez, Chief Executive Officer of Class Valuation, coming in to talk all things appraisal, state of the industry, where we're at today, what are some of the cool initiatives and technology and things that are going to be continuing to expand as we go forward, and really what's the future of appraisal look like. So I'm looking forward to having them. Thank you so much for joining us. As always, appreciate you. Can't say thank you enough for your partnership with Flagstar. We truly appreciate it. We know you have choices, and at the end of the day, we try our best to be one that you can count on. So hopefully it's spark value and God, make it a good rest of your day. Have a great day.